A group of NRI investors made headlines recently when they sued ICICI Venture Fund for not delivering on promised returns. Is this just a case of bad timing, or are investors being too unrealistic in their expectations? More importantly, how are other real estate funds coping with the weak industry sentiments? Nikhil Sivadas has this report.
In October, ICICI Venture Funds was in for a rude shock. A group of 78 NRI investors filed a suit against it, claiming that its real estate fund, the Dynamic India Fund 3, had not delivered on promised returns.
They deliver the things in such a way and presented in such a way that there will be clear exit policy. There will be a clear financial analysis. Then in between, they have started using the legal words. And then we smell that their intentions may not be clear. They have started showing that you have signed this document, you have signed so and so, there is a risk factor, how we have not promised you.
ICICI Venture Funds claims that the suit is without merit and that returns were never guaranteed. While that battle goes on in the courts, this case has highlighted the growing dissatisfaction among investors when real estate funds don't deliver. To be fair, most of these funds were launched in 2005 and 06, at a time when the India growth story had never seemed stronger. But the following global economic crisis and the ongoing real estate slump has taken its toll. Real estate funds say that investors cannot expect the returns that were promised back then.
I think the band of investments from a FDI perspective should be somewhere between the 15 to 20% range. I think if the expectation is more than that at an India level, then I think it's unrealistic.
But a portion of the blame has to be shared by real estate funds as well.
What ICICI Ventures did, I think they are well aware. They are very well informed about the local conditions. But sometimes, property specific or developer specific could be a decision that they, could have, approached it differently.
Even if an investment lost money for very valid reasons, an investor would understand that. But when they're kept in the dark and not notified till the last moment, they're not consulted or properly explained the situation, that's when the problems occur.
As a result, funds today have begun changing strategies to cope with the new environment. Due diligence has become more thorough, with funds trying to find the right player for the right investment in the right market. Realistic returns, specific investments and deals are the order of the day. Smaller developers who are in a hurry to turn around projects faster are finding favor, as compared to bigger developers who are financially stable enough to take things slow. Additionally, funds have also begun to sweeten the pot by matching investments to encourage investors.
Somebody is putting, $100 million. The GP owner is committing another 100 million to match that investment. What that has done, that has assured the investors outside that there is still some skin in the game for the fund manager or the owner of the GP, and therefore the interests are aligned.
Industry analysts say that these efforts will go a long way in reassuring investors. That's because investors are still hopeful about the India growth story. With a new government in place and sector-friendly policies coming in, the next few years could very well be the turnaround the Indian real estate sector so desperately needs. From Mumbai, Nikhil Sivadas, NDTV.
All right, so what should high net worth investors be doing? After all, real estate funds aren't a game for everybody. It's pretty much a high net worth investor game. Kuldeep Chawla, founder and CEO of ASK Strategies, and Shashank Jain, ED and leader Real Estate Transaction Services, PwC India. Welcome, gentlemen. Samir, of course, also has inputs on this particular discussion. Kuldeep, first up with you. What really happened? I mean, I do know that 25% enthusiastic fund managers, whether it's a mutual fund of 10,000 rupees which is being sold, it's always, if the fund has done very well, hey, look, it's done 22%, and that's the kind of money you can expect. So I'm just wondering, why does this group of investors feel that their case is stronger against ICICI and that so-called possible returns of 25% that they were shown?
So I think there are, I think there are a few parts to this. Part one is, and I'll generalize it beyond just the specific instance, because what you're seeing in one instance is a matter that is come to a head because the fund life has come to an end, and it is likely and very probable that you will see other actions being taken, whether they play out in the public domain or not. They're certainly happening in the private domain. So like I said, there are two parts to this. Part one is that it could be a developer specific, project specific, or location specific issue. But the wider issue, and that's the second part, is that, what did the investment manager do? A, in terms of disclosure, which you would expect any qualified investment manager to do. So that's one, is disclosure and transparency. And the second issue is corrective action. Because if you look at it and you have, let's say, 10, 15 investments in the portfolio, it's very difficult to believe that 80-90% of those investments have done poorly. Because it's a portfolio, it's very likely that one or two investments will do poorly. But if you're doing real estate, and unless you're taking significant risk, your capital would not be at risk. And that's the big difference, between most real estate investments and venture capital or early stage or private equity investments which are not in the real estate domain.
All right, Shashank, for the sake of our viewers, explain to us, number one, already as per the SEBI regulation, the ticket size for any such private fund is 1 crore plus, am I right?
Yep.
All right, so really it's high stakes. In that case, these are all informed investors. How are these funds sold, and then where does the money which is collected, I know I'm asking very low common denominator questions, but it's important for everyone to understand, where does that money collected really get invested when you say it's a real estate fund?
See, this is a model which has evolved, which is a very recent phenomenon, has evolved over the last few years, where we've seen influx of HNIs or individual investors, taking a collective risk. I mean, the age-old traditional models of HNIs investing on their own real estate has been there in existence for a long time. So it's sort of got a little bit structured and formalized, where investment managers are raising these, retail funds, so to say, where they reach out to HNIs and individuals with high net worth and pool together the money to deploy it. Now, it's got its own set of challenges as well as advantages. Coming to the challenges, while the investors are all educated, and a lot which is sort of aware of the markets and the ground realities, they may not necessarily appreciate the formal process of deploying funds, returns and exits, etc. Unlike financial institutions, unlike structured funds which have been there in existence for a long time. So managing a wider set of retail investors really could be challenging, and it some ways sometimes gets akin to selling financial services products, where while you may have all the paperwork right, but what message have you given at the time of selling or fundraising tends to get stuck in investors' mind. So it's really about managing expectations at the time of raising funds, which becomes very critical. I think the advantage is, unlike institutional investors where you have to go overseas, where things like country risk, currency risk, etc., tend to weigh heavy on investors' mind. If you're raising a domestic, fund, let's say, from retail investors, those kind of things do not sort of tend to play a larger role there.
Right. God forbid if the currency risk also had to be taken on this particular fund, then the returns would have been nothing. I mean, most of the capital would have got wiped out. All right. Samir, tell us, I mean, even now, every year there are funds getting launched. You have a Kotak fund, you've got HDFC. In fact, some of them have also done well. Let's not just take the case of this particular fund. There are some HDFC funds which have actually gone ahead and given investors 18, 20, 22% returns. It's just also a question of timing. But look at the investment scenario, look at the way real estate is playing out, both on the office commercial space and residential. Do you think that funds which are getting launched now are worthy of retail money?
Yeah, absolutely. I would think that this business of fund management has become quite mature. Fund managers and both developers have learned a lot from their mistakes done in the past. I think there were 2-3 reasons primarily why real estate funds didn't make that kind of return. Of course, currency being one of them, but most importantly, there was one, that the execution capability of the developer was not really checked, or due diligence was not done enough. And the second reason was really that the demand supply was not analyzed properly, because there was not too much data that was available. So everybody expected that if somebody invested in a project, that project would get 100% sold, and spreadsheets were based on those kind of models. And to our surprise, that didn't really work out properly, and that's why funds have not made that kind of return, because projects have got delayed and sales have not happened to the expectation of the spreadsheet model.
Okay.
Now I think what has happened is that everybody now is discounting sales, especially in today's market, because sales are going slow across India. Developers need cash at this point in time, and there are significant amount of opportunities that are available for private equity funds to come in and be able to invest into a project at the right price point. So I think it's a win-win, because developers now need cash. They will sell at a lower price in terms of giving it to the private equity investor, taking investment, and at the same time the PE fund will end up making money, because also most of it is kind of structured debt.
All right, it is structured debt. That's what we are hearing as well. Kuldeep Chawla, does that take away the risk to a large extent? The fact that developers are desperate, are willing to come down, pretty much write out any kind of, or sign on any structure or deal that the private equity firms presenting them?
Not necessarily, but let me just add a few points to what Samir said very quickly. Number one, I think there are mistakes on both sides. Let's not take away from that fact. Number one, I think real estate as an asset class, real estate private equity is very different from non-real estate private equity. Okay, so you had a lot of investment managers who did not have sufficient Indian real estate experience, Indian real estate investing experience, and B, I think most Indian real estate investments needed to be in a co-development format, which is very different from the way most real estate private equity is done globally. So you could not just transplant expertise from overseas, into India. So that's an error on the part of the investment managers, apart from all the demand, supply, and all the rest of it.
Shashank, do you think that investors should now actually bite into funds, real estate funds? That's the big question.
See, today's times are a little dangerous, I would say, even from an investment perspective, because what we're seeing, as you said, and Samir alluded to, these are not the best of the times in the real estate. The market isn't still fully picked up. Developers are still cash strapped. So what we've seen, most of the deals are sort of refinancing deals where developers are raising high cost fund to provide exit to or repay some of their existing funds, and not necessarily financing new projects. To my mind, that's not a very comfortable situation, because what developer is essentially doing is deferring his repayment obligations. So that's the developer side of it. On the fund side of it, I think the investment managers have learned their lessons. The focus on due diligence is far greater. They are looking at ring fencing their cash flows, their investment. They are looking at making sure that the exit strategies are clearly laid down and agreed upon. So to that extent, it becomes a win-win situation where developers are getting opportunity for refinancing. At the same time, the fund managers are making sure that they do not, as Kuldeep said, take equity risk, but get covered themselves, as a debt provider, so to say.
All right, gentlemen, thank you very much for joining me. We've completely run out of time, but the message is very clear. Probably, rather than risking your money 6 years ago, if you risked your money today as a high net worth investor in a real estate fund, you had a better probability and a better chance that you would make decent returns. Do not expect very, very big numbers, because that's of course something that the fund managers will promise you, difficult to accomplish. More transparency is something that the investors have to demand, and funds must provide to all the HNIs investing in their fund.